Stablecoins are cryptocurrencies designed to maintain a steady value by pegging them to assets like the US dollar or gold, offering crypto speed without price chaos. Unlike Bitcoin, whose price swings wildly, stablecoins stay steady, ideal for everyday use, trading, and remittances. They act as a reliable on-ramp into crypto spaces. There are four main types of stablecoins. Fiat-backed. Each coin is supported by actual US dollars, like USDT or USDC. This is the most common. Backed by crypto and smart contracts, like DAI, often over-collateralized. Commodity-backed, pegged to things like gold, or algorithmic, relying on software to adjust supply, a risky experiment like Terra UST. This is an easy flowchart to understand how it works. A user will exchange US dollars for a stablecoin. The stablecoin issuer, like Coinbase or Circle, will deposit that US dollar at a bank. Those US dollars are now held in reserve to meet short-term liquidity needs. The remainder of the reserves may be invested just like a bank does today to try to make income on the money that you just deposited. You are then provided with a value of stablecoins equivalent to their initial deposit. So if you deposited $500, you would now have 500 stablecoins. The user can then hold those stablecoins with a centralized custodian, like your current bank, or a Coinbase or Circle, crypto trading platforms, and also exchange the money between other blockchain networks for additional cryptocurrencies. There are a lot of applications for this. You can use it as an everyday currency. Stablecoins facilitate fast, low-cost international payments, help traders move between assets, and serve as a stable digital savings vehicle. The new Genius Act in the US mandates full reserves and audits for fiat-backed stablecoins, boosting safety. But they are not FDIC insured, like we have today, worth up to $250,000 in your bank accounts. And centralization, which is the opposite of cryptocurrency, those being decentralized, bring counterparty risks, like the introduction of foul play. Now, there are challenges ahead. Algorithmic versions have failed. With centralization, regulatory scrutiny, and energy concerns, the industry still faces questions, but its potential for global finance remains strong. Stablecoins may be crypto's stable foundation.
Ever wondered how to use crypto without the wild price swings? Meet stablecoins, the steady players in the volatile crypto world. Bitcoin can jump 10% in a day. Ethereum can crash 20% overnight. This makes them tough to use for everyday transactions. Would you buy coffee with money that might lose half its value by lunch? That's where stablecoins come in. These are cryptocurrencies designed to maintain a steady value, usually pegged to the US dollar. 1 USDC or USDT typically equals $1. Stablecoins stay stable through different methods. Collateralized stablecoins like USDC and USDT are backed by real dollars in bank accounts. Algorithmic ones like Terra USD tried using smart contracts to control supply, but collapsed in 2022. Crypto-backed stablecoins like DAI are secured by Ethereum and other cryptocurrencies as collateral. This stability makes them perfect for sending money across borders, trading crypto without cashing out, or storing value without traditional banking.
The shift to fully virtual currency seems inevitable. We're already halfway there. Most money exists as digital entries in banks, not physical cash. Stablecoins, central bank digital currencies, and crypto wallets will soon replace paper currency for convenience, security, and global accessibility. Which cryptocurrencies win out is yet to be seen. But this transition raises questions. Who controls the system? How do we protect privacy? And what happens to people without access to tech? Virtual currency promises efficiency, but the challenge will be ensuring it remains inclusive and resistant to misuse. Let me know your thoughts.